You're watching Notepad. My name is Ibrahim Sani. We start off the week with a strong one, which is trying to find for better investment ideas, trying to look for geographical areas that might be of interest to us, and of course, the investment tools that are correlated to the kind of investment needs and strategies that we want to employ. One of the reasons why we want to do this is because some macroeconomic activities are currently taking place. The G7 meeting, for instance, have just been concluded. China is flexing its muscles, both militarily as well as economically around the region, and how the Western versus the Eastern world is going on with the world's business and seems to have negated the issue of COVID and put them behind. And of course, Malaysia is still struggling with COVID. So there's a lot of starting places when it comes to rejuvenating the global economy, the national economy, as well as our own personal circumstances and personal finance. So there's a lot that needs to be unpacked here. Because of that, I have the pleasure to have joining us for this evening Kamal Mustadza, the fund manager at Value Partners Asset Management. Kamal, thanks for taking the time to speak with us.
Pleasure to be here.
Like I prefaced just now, there's a lot of things that are currently happening right now, and I wanna focus a little bit more about investing in China and Chinese investing in this part of the world, including that of Malaysia. Let's do a quick recap into how the investment landscape is stacking up right now. Where do we stand when it comes to a post-pandemic world and investment in China?
Yeah, hi Ibrahim. So I think basically we have to address the elephant in the room, of which the 2020. It was a very challenging year globally. I think we saw the COVID-19 pandemic hit the world by surprise, and this resulted in the contraction in the world output. But even then, China is one of the few countries that still managed to record a positive GDP growth at about 2.3% last year, and this is driven by its swift response to the COVID outbreak. So fast forward to 2021, COVID remains in the headlines, but with vaccination rollouts and the rebound in the global demand, everyone is looking at this year as the year of recovery. I think we can see that the World Bank in its recent 2021 Global Economic Outlook actually upgrades the global growth estimate for 2021 to 5.6% from the 4.1% previously. And a bulk of it will be coming from the few major economies like China, which is expected to grow by a whopping 8.5% for this year. So coming back to China, though the current environment is clouded by uncertainty over the ongoing trade tensions between China and the US, the fundamentals still give cause for optimism given the high economic growth for this year alone is expected to be the highest that we've seen in 10 years. And from the medium to long-term perspective, they are one of the most appealing asset classes there is. So the correction that we saw in China stock markets earlier this year actually offers an excellent opportunity both for short-term deep buying as well as the long-term growth in our view.
So what do you mean by great optimism in terms of potential to buy in? What makes China so great?
I think if we look at the current situation now, China is basically the second just behind the US in terms of the real GDP. So with China is growing at about 4.5% to 5.5% roughly versus US probably secular growth of about 2%. We are looking at China to actually surpass US as to become the largest economy in the world by probably early 2030s to 2035.
What about potential assets that could be looked at? Does this mean that it's going to be pricey compared to other markets?
I think if we look at a 10-year horizon, it's relatively cheap. And like I said, I think the recent correction actually provide a buying opportunity for investors.
What about fees when it comes to purchasing these assets, be it through ETFs or any other form of products? Do you think that managers like yourselves are going to be able to charge competitive rates, or is it still going to be the way it was, say, pre-pandemic?
Yeah, I think when it comes to the Chinese market, they are still relatively young when it comes to opening up to the world. So basically, there's a lot of, active funds are still largely dominate the market, of which these active funds command a higher fee premium compared to other products. We saw that globally the fees are going down, and definitely this will hit China sooner or later. But we believe at this current juncture, the fee is still, the fee premium is still applicable to China.
So you don't think there will be some price differences between pre-pandemic and post-pandemic?
Not so much, yeah.
Let's marry this with the current ongoings in the world as we opened the show just now. G7 is quite in the news. A lot of leaders are attending it for the first time. The Prime Minister of Japan, Joe Biden, and of course this will be the final meeting for Angela Merkel. And Boris Johnson, of course, led the front seat because of this being taking place in the UK. But the general tone of G7, the way I look at it, right, my personal view is that two themes came out. Number one, it seems like COVID is something like a done deal for them. It seems like while they are concerned about the current spikes of cases elsewhere around the world and all that, it seems like business as usual is about to resume. That's what I get, the feeling that I get from reading out the reports of G7. The second thing that I got from the G7 meeting was that it's very much us versus them, the Western world versus China. And if you look at the comments given by some of the G7 leaders, from Boris to Joe Biden, even through the words of the Prime Minister of Japan, it seems like they are coalescing with each other so that they can, quote-unquote, combat the rise of China. When we have such posturing coming in from the G7, we are a small nation, we're a small country, we're a small economy, and of course, to the many of us that are currently watching this show as well, between you and me, we are small investors. How do we stack up and how do we relate between the G7 movements versus the Chinese movement? Should we be worried? Is there a risk escalating somewhere, or is it just normal to see this kind of posturing behaving coming from the G7 as well from the Chinese businesses?
Yeah, I think from our point of view, I think this is normal. I mean, especially like I mentioned before, I mean, China continues its growing influence in the global economy, and definitely the G7. I mean, in a way, G7 actually admits this is happening, and I think they try to actually counter this rising influence. But I think it's a bit short-sighted in terms of what they want to achieve.
No, you're right. They do admit it. They admit that the rise is real and it's material, and therefore the issue of combating it becomes a primary focus. Let's go for a short break. When we come back, we'll talk more with value partners that's coming up after these messages. Thanks for staying on with us. I have with me on the line Kamal, Mustadza, the fund manager at Value Partners Asset Management. We're talking about China. We're also talking about the G7 economies and how we stack up against all these current ongoings in the world. In Malaysia, for the past few years now, we've seen foreign outflows in our capital market. And sometimes it is exacerbated based on external macro trends. Sometimes it's a bit slowed, but generally speaking, it's more outflow than in. But when we talk about China, fund flows, trends, and outlook on foreign capital flows coming into China is also important to be discussed. So, Kamal, can you share with us some of the trends when it comes to the fund flows coming in and out of China? Where is it coming from? Where is it going? What does it tell you following this kind of movements?
All right, I think when it comes to the fund flow trends, the key drivers were still about COVID, the inflationary concerns, as well as regulatory, as well as the policy uncertainties. So if we look at among the emerging markets, China is still recording positive foreign inflow through May, with year-to-date net purchase for local stocks via the trading links hit about 32.2 billion US dollars. And this already exceeds the 2020 entire tally at about $30.6 billion. So from our point of view, we remain positive on the outlook for the foreign capital inflows into China. This actually is driven by, I mean, not just 1 year, but I mean the foundation that was built up into this trend is actually we see in the past 2-3 years. Where the positive developments and continuous improvement in market accessibility actually saw Chinese stocks and bonds market grew rapidly and become too big for the global investors to ignore. And interestingly, 2019 was actually a monumental year for the China stocks. with the start of greater inclusion of onshore stocks and bonds as index providers, including MSCI, FTSE Russell, and S&P Dow Jones actually increases the inclusion factor for the A shares, while the inclusion of China onshore bonds in Barclays and JP Morgan Index actually give rise to the unprecedented foreign inflows into China. And this, we believe, is going to be a multi-year story. So this, coupled with the China's economic growth story that we are likely to see in the coming decade, are the long-term key attraction that will support our outlook on the foreign inflows into China markets.
What people don't normally realize is that when we invest overseas, we have to look into consideration of our currency. If you pull in a 5-year chart of the ringgit, it's actually quite stable if you think about it, anywhere between 3.8 to 4.5 over the past 5 years. Like I said, there's waxes and wanes, and if you narrow down that whole timeline of ringgit versus USD from 5 years to 1 year, you're going to see us actually strengthening over the past 1 year since the COVID pandemic started. But having said that, would you argue that the ringgit is going to continue to strengthen and perhaps we get more value from our buck from investing in places like China or elsewhere outside of the country?
Yeah, I think when it comes to the ringgit, the strengthen that we see in ringgit is probably because we saw the high commodity prices, which includes the energy and palm oil, which is a big part of the Malaysian economy. And then when it comes to China, definitely the capital gain that we are likely to see from investing in China is huge, and it's too big for anyone to ignore.
What about Sharia? Do you think that Sharia still has a place when it comes to investors in Malaysia? Are we still Sharia conscious, so to speak?
Yeah, I mean, being one of the larger and more developed Sharia capital markets in the world, we are definitely, big in terms of the Sharia investing. But at the same time, I think there's a gap because there's a lack of Sharia compliant China Asia's product that is available in the listed and unlisted space. And I think this presents a huge opportunity to provide more access to China Asia's market among the Sharia compliant or ethical investors. And interestingly, Ibrahim, if I may add, there's also another value proposition for the Sharia compliant products in terms of the China Asia's, which I believe is quite interesting. So if we look at currently the CSI 300, which is the benchmark for the China Asia's, have high exposure in the financial sector, which is comprised about 25% of the index. And we know that the financial sector, along with real estate and other highly leveraged state-owned enterprise, were the main drivers of China's old economy that we've seen in the early 2000s. So based on our proprietary study, we found out that if we apply the Sharia screening to China Asia's, so in the absence of financials and highly leveraged SOEs, the resulting composition of the index will skew towards what we consider the new economic drivers, with exposure in sectors like healthcare, IT, and consumption. And again, this also echo what China plans to achieve under its 14th five-year plan, with focus on boosting domestic consumption as well as the technological innovation. So yeah, definitely the opportunity for the Sharia space is quite huge.
Okay, sorry, I didn't get that. Financials, consumption. What was the third one?
Sorry, the healthcare, IT, and consumption.
IT. Okay.
Yeah.
Now, I think healthcare and IT, it's quite straightforward when it comes to getting Sharia certification. Financials is a bit tricky because of the riba element. Do you feel that some sectors would probably be seeking for Sharia certification faster than others, simply because it just opens themselves up to better and more investors or investor base?
I think for them, they don't really have the incentive as of yet, because when it comes to the Sharia investing as a portion of China's whole market, I think it's very small. But again, I think this is just an opportunity waiting to be harvested. For investors. Once there's growing acceptance into it, I believe that potentially these companies will actually try to get the Sharia certification.
When do you think that will happen? Anytime soon, or still very much down the road?
Yeah, I think it's still very much down the road.
Okay.
But we have to take the first step, right? Yeah.
Kamal, you're an active investor. You're handling your clients' funds. I, however, am not keeping an eye on the market. I'd rather go with either ETFs or any other bundled products, and I find it hugely consuming for me to keep an eyeball on the market. Do you feel that there is a value for us to talk about ETFs still? Do you think that this is still something that some segments of the market would want? People like me, for instance.
Yeah, definitely. There's always a room for ETF, especially in market like Malaysia. So we know that Malaysia is pretty much on the active fund side, where I think ETF is still relatively infant when it comes to, relatively to the active funds. So we can see that there's a lot of gaps in the ETF landscape in Malaysia, and I think that this is where this is how we as a fund managers can actually tap into this segment to provide access, a cheaper access to investors to invest in.
All right, so I can see I can build a 4-quadrant here: ETF, China, Malaysian investors, and price sensitivity. Do you feel that there's an intersection between these 4 big ideas and perhaps create a product that can serve all 4 needs?
Yeah, definitely. Definitely, there's opportunity to combine all the 4 quadrants that you mentioned to create a one-stop solution for every investors to invest in.
But price have to be really competitive lah. It's a bit tricky, right?
Yeah, definitely. Price is always, it's a tricky part.
It's like me going to your shop and say, minta discount lah sikit. That's what I'm trying to say. Let's go with hidden gems in China. Do you want to share some ideas on what you think is possibly attractive? Some ideas that investors might often overlook, things like that.
Yeah, so I think for China, we expect a broad-based earnings recovery and a balanced return profile among the sectors for this year. But that being said, we continue to be positive on the structural stories relating to the consumption upgrade, education, as well as healthcare in China. In addition to that, certain segments that still benefit from the economic recovery, such as the shipping companies, are also within our radars and have become performance contributors of late.
Right. We'll go for one more short break. When we come back, we'll continue on our conversation with Kamal. Welcome back. We have with us our very much interested person talking about the Chinese landscape, Kamal Mustadza, Fund Manager of Value Partners Asset Management. Kamal, I want to step away from fund managers and all the other stuff that we've spoken about earlier. I want to talk about China as a country because when Chinese government released the census data last month, it was revealed that the extent of the population slowdown is actually quite severe. The country's fertility rate is now one of the lowest in the world. Last year, the number of births were similar to those of the early 1960s when China was struggling with multi-year famine. And of course, China of 2021 is not China 1960. GDP per capita is actually quite high, and then when you multiply that with 1.4 billion population, we're talking about the world's second biggest economy with the trajectory to become the world's biggest economy. But on the landscape of low child growth and extent of population slowdown is actually quite severe. It's too stark to ignore. And because of that, the Chinese government have announced a new 3-child policy, further relaxing population controls that have been in place for over 4 decades. What do you think this is signaling to markets, to people like us? How do we observe this development?
Yeah, I think first thing to note here is the fact that the fertility rate was about 1.3. This is lower than the replacement level of 2.1 that is needed for a stable population. And we know that the birth rate of China is now at a 60-year low. So the announcement is, I think, as a result of this census that were released last month. But from our point of view, I think we don't really see any imminent immaterial impact or actual benefit, at least in the near term, from this policy shift, as it aims to resolve the inevitable demographic issue regarding the aging population in the long run. And I think the big question here remains on whether the policy shift will work this time around, given the last changes from 1-child to 2-child policy made in 2016 failed to yield the intended results. I understand that when they announced the three-child policy, they also said that they are going to come up with supportive measures to ensure that this policy is going to be a success. But I think at this current juncture, we are still waiting to see what these supportive measures is going to look like.
What do you think it'll look like then?
I think given the concern, I think on the low fertility rate, I think people always associate it with the high cost of living. That's why they are less likely to have more child. So I think the financial incentive will be key for this policy to actually works.
You know, if you look at population density maps across countries that have big geographies, like the US, Australia, and China, they all tend to congregate near the sea. You know, eastern seaboard, western seaboard. For America, you know, something like 60-70%. I mean, don't quote me on the numbers, but the majority of Americans do live, you know, on either on the eastern side or the western side. Australia's the same thing, you know, it's practically empty in the middle, and then everybody there in Sydney, Melbourne, Brisbane, and then over there in Perth. The same can be said about China, Beijing, Shanghai, Shenzhen, Guangzhou, and then everything else is void in the middle. Do you think that China needs to think about how they are moving people around the country, perhaps even try to lower the density of population? I don't know, these are just some ideas I'm thinking out loud.
Yeah, I think they should start looking at it, but I think it's a very difficult feat to achieve. Especially, I mean, if you want to do that, I think definitely the infrastructure spending has to be very huge to enable, I mean, job creation as well as the infrastructure spending to blossom, especially towards the inlands, the China inlands.
All right, one more thing that I want to talk about is digital renminbi or digital yuan. This is, of course, the PBOC's or the central bank initiative trying to create a digital currency. And there's a lot of talk about this. Is it more, I don't know, how does this impact us in the long run?
Yeah, I think the push clearly shows that China is leading the charge in terms of the global race for the future of money. I think it is still too early to ascertain the impact of this development at this current stage, given the fact it's still being experimented throughout Chinese cities. But I think the key message here is that we think that China acknowledged the potential benefits behind the central bank digital currency or CBDC, given the potentially wide range of application, and therefore they really wants a piece of action in it as well.
Do you feel that this is going to have a material impact towards cryptocurrency then, and how people use Bitcoin and the likes? Do you think that that will have something of a bearing of a change between, you know, cryptocurrency versus digital renminbi, or is it going to be working in tandem? I don't know. These are all speculation, but what do you think?
Yeah, I think China has been quite hard on tackling the cryptocurrency. So I think they just want people to focus on the CBDC as the way forward. I think given the fact, I mean, one is centralized and one is decentralized. So when it comes to this decentralized cryptocurrency, I think it's very difficult to manage, and I think the systemic risk that comes from this decentralized cryptocurrency is quite huge for markets like China.
So when it comes to commodities, final questions for you. I want to talk a little bit more about the commodity surge. At least for Malaysia, has been doing well. CPO prices have been blossoming, and a lot of Malaysian manufacturers or planters are actually enjoying these kind of surge right now. But when we talk about the commodity surge in relation to China, how do you think this will pan out?
Yeah, I think we saw that commodities across the board has been on the uptrend since mid last year on the back of the surging demand on as the global recovery gathers pace. So this meteoric rise in commodity prices raised concern about high inflationary pressure, which is detrimental to economic growth just when economies around the world start to rebound following COVID outbreak last year. So basically, this is a concern not just in China, but as well globally. But if we look over to China, the brunt of high commodity prices are felt as the producers' price index actually jumped 9% in May a year earlier, higher than the expectation, while the consumer price index only rose by about 1.3%. So this gap between the production cost and the selling price has been the highest on record, and it actually indicates that manufacturers or the commodity users are not able to pass the higher cost to the consumers fast enough, which in turn will eat up into their own margins. So with the earning cycle seen peaking, the downstream companies and manufacturers may continue to be under derating pressure from this margin squeeze and the higher inflation expectation.
And so, because of these expectations of a higher inflation rate squeeze, do you think that folks, investors that are concerned with commodities should really take the next few steps quite warily and not be buoyed by the surge of prices right now?
Yeah, I think we have to be cautious on this front because we already saw that Chinese government last month sent warnings against the commodity speculators and hoarders in an attempt to rein in the price surge. And I think we saw as a result of that, actually the price of the commodity actually eased up a little bit before actually went up again. At the same time, I think in recent weeks, we're also hearing news that Chinese government is looking to release some state reserves and stockpiles in order to curb the prices. So price stability has always been one of the foremost priorities of the Chinese government, given the effect it has on the economy otherwise. So in the event of the prices continue to increase in this unprecedented manner, we should anticipate further cooling measures to be announced by the Chinese government.
What about?
I think investors should not chase the short-term stories, but rather focusing on the long-term structural stories there. Yeah.
Yep. Okay. And I mean that's a good advice, regardless of how the prices are floating. But I want to talk about futures. Do you think that futures now play a key role for investors to think about?
Yeah, I think for these commodity traders, I think in a way to hedge against the unfavorable price movement in the commodity, I think that the futures are one of the tools they can use to hedge. But I think the concern that the regulators in China has is it becomes a tool for speculators to fuel in the fire.
Yeah. Well, look, if speculators burn, they burn, right? I mean, I have a friend who was trying to buy a house, and then the pandemic hit. Now he can't get rid of the house. I'm sorry, but he was a speculator. So, you know, you. Final thoughts on the matter. What do you think of investing in China and the Chinese market before we end the show?
Yeah, I think again, I like to reiterate that I think how we view China is that investors should look at the long-term structural opportunities rather than chasing the short-term stories. And I think the stories about the consumption upgrades and the technological innovation, I think actually goes in tandem with what the Chinese government plans to achieve in the next 5 to 10 years.
Fantastic. That's a good way to end. That was Kamal Mustadza, Fund Manager, Value Partners Asia Asset Management. If you missed any part of the show, just head on to astroawani.com, look for Notepad or look for Value Partners there. Until then, thanks very much for watching and goodbye.